Imagine waking up tomorrow and realizing that one of the most important assets for the future of technology, energy, and even money itself has been quietly held down for years, not because of chance, not because of simple market cycles, but because powerful incentives exist to keep it that way. Silver is everywhere in your life. Inside your phone, your laptop, solar panels, electric vehicles, medical equipment, and military hardware. Yet the companies that pull it out of the ground are trading like they're on the brink of extinction. That contradiction is not an accident. And once you see how it works, you can never unsee it. To understand why silver miners appear suppressed, you first have to understand what silver really is in the modern world. Many people still think of silver as just a poor cousin to gold, a shiny metal you stack in coins or bars as a hedge against inflation. That's only half the story. Silver is a monetary metal with thousands of years of history, but it is also one of the most critical industrial metals on Earth. Unlike gold, which mostly sits in vaults and jewelry boxes, silver gets consumed. When it's used in electronics or solar panels, much of it is not economically recoverable. That means every year, part of the global silver supply is permanently removed from circulation. Now ask yourself a simple question. What happens when demand keeps rising but supply is steadily shrinking? On paper, the answer should be obvious. Prices should rise, and the companies that mine silver should become extremely profitable. But when you look at the charts, you see something strange. Silver miners, especially junior and mid-tier producers, have massively underperformed not just the broader stock market, but even the metal they produce. In past bull markets, silver miners were leveraged plays. If silver went up 20%, miners might go up 50 or 100%. Today, silver has spent years trading well above the all-in sustaining cost of production for many miners, yet their share prices remain depressed, diluted, and ignored. This disconnect is the starting point of the suppression argument. One reason often given is simple mismanagement, or poor capital discipline, and yes, that plays a role. Some miners overexpanded during past bull markets, took on debt, and paid the price. But that explanation does not fully account for an entire sector being priced as if it has no future, especially at a time when governments are openly pushing electrification, renewable energy, and grid expansion. Solar energy alone uses roughly 20 grams of silver per panel. As solar installations scale globally, that demand compounds year after year. Electric vehicles use significantly more silver than internal combustion cars due to their electronics and power management systems. Add to that 5G infrastructure, data centers, and defense applications, and you have a structural demand story that is hard to ignore. Now let's talk about supply, because this is where things get uncomfortable. Global silver production has been relatively flat for years. Unlike gold, most silver is produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply does not respond quickly to higher prices. If silver doubles tomorrow, you don't suddenly get double the silver supply, because miners are focused on the primary metal. Dedicated silver miners are relatively rare, and many of the world's largest silver mines are aging, facing declining grades and higher extraction costs. In mining terms, declining grades mean you have to dig up more rock to get the same amount of metal, which raises costs and squeezes margins. So if demand is rising and supply is constrained, why aren't silver miners thriving? This is where financial markets enter the picture. Silver is one of the most heavily traded commodities on paper. Futures contracts, options, and derivatives represent claims on silver that vastly exceed the amount of physical metal available. This is not unique to silver, but silver's smaller market size makes it more vulnerable. When large players sell massive amounts of paper silver into the market, they can push prices down without needing physical supply. This price action directly impacts miners, because their revenues are tied to the spot price, even if physical demand is strong. Think of it like this. Imagine a farmer growing wheat in a town where a powerful group controls the wheat exchange. Even if everyone in the town needs bread, if the exchange sets a low price based on paper contracts, the farmer struggles, not because his wheat isn't needed, but because the price signal is distorted. Over time, farmers stop planting, supply tightens, and eventually the system breaks. Silver mining is facing a similar dynamic, but on a global scale. Another layer of suppression comes from capital markets themselves. Mining is capital intensive. Companies need financing to explore, develop, and operate mines. When silver prices are held down, investor interest fades. Institutional investors prefer tech stocks, bonds, or large diversified miners. Silver miners, especially juniors, are seen as risky, volatile, and illiquid. This forces them to raise capital through share dilution at low prices, which further depresses their stock and creates a vicious cycle. Critics then point to dilution as proof the sector is broken, ignoring the fact that the low prices caused the dilution in the first place. Now let's zoom out and look at the bigger picture. Why would anyone want silver prices, and by extension, silver miners, suppressed? One answer lies in confidence. Precious metals have historically been a barometer of trust in fiat currencies. When gold and silver rise sharply, it often signals inflation, currency debasement, or financial stress. Governments and central banks have a strong incentive to maintain confidence in the monetary system. Silver, because of its dual role as money and industrial input, sits at an uncomfortable crossroads. A rapidly rising silver price would not just signal monetary trouble, it would also increase costs across the green energy transition and high-tech manufacturing. Imagine policymakers pushing aggressive renewable targets while the key metal for solar panels triples in price. That would raise costs, slow adoption, and expose contradictions in energy policy. Keeping silver relatively cheap helps maintain the narrative that the transition will be smooth and affordable. At the same time, it keeps inflation metrics lower than they otherwise might be because silver is embedded in so many products. This doesn't require a single secret meeting or conspiracy movie plot. It can emerge naturally from incentives. Large financial institutions profit from trading paper silver. Industrial users benefit from stable or low prices. Governments benefit from subdued inflation signals. The losers are the miners and long-term holders who understand the physical market. Over time, this creates a pressure cooker. The longer prices stay artificially low, the less investment flows into new mines and the tighter physical supply becomes. History gives us a warning here. In the late 1970s, silver was heavily shorted until physical demand overwhelmed the paper market and prices exploded. That episode ended badly for some speculators, but it proved a fundamental truth. Paper claims cannot create metal out of thin air. When physical shortages become visible, price discovery can be violent. Today's silver market is far larger and more complex, but the underlying principle remains the same. For silver miners, this sets up a paradox. They are essential to future technologies, yet starved of capital. They sit on assets that could become enormously valuable, yet are priced as if those assets don't matter. This is why many long-term investors believe suppression is not just happening, but happening on purpose, whether consciously coordinated or structurally reinforced by the system itself. The question is not if this can continue forever, but how it eventually ends, because